Good morning. It's Jeffrey Christian of CPM Group. Welcome to our annual briefing for our annual Silver Yearbook, the 2024 edition. We've been producing these yearbooks on silver as a group going back to the early 70s when it was J. Aaron and Company's research department. Then it became Goldman Sachs's commodities research group when Goldman bought J. Aaron in 81, and since 1986 as CPM Group after the Commodities Research Group from Goldman Sachs. J. Aaron spun off and set up CPM Group to be an independent, unbiased source of commodities research, analysis, and financial services. Today, we will be releasing the report later today. Which we'll be releasing it later today. During the briefing, which should last 1.5 to 2 hours, we will open it up for question and answer period. There is a space on the, whatever that is, for GoToWebinar where you can type in questions. And the schedule will be, I'll talk a little bit about the market today. Then I'll pass it over to Rohit Savant, who is the head of our precious metals research director and the chief author of our precious metals yearbooks and chief author of this yearbook. He will run through the fundamentals of the silver market in much greater detail. Then we'll open it up for Q&A. So that's the schedule today. And again, if you want to ask questions, you can type them into that question bar. Before I start, we have to thank our sponsors and our Chinese partner. Our Chinese partner is Shanghai Huatong Silver Exchange. They translate and distribute these reports in China. They are the physical silver market within China. And they have been doing this for, I guess, well over a decade now, and we appreciate the relationship with them. We have sponsors from around the world and across the different segments of the market. We're not just taking money from silver producers, and we're not a promotional agency saying, hey, people should buy silver. We have the Bulgarian Mint, which produces silver and gold medallions. They do a lot of blanking for other mints, and then they also produce medallions and coins for themselves. Endeavor Silver Corp, obviously a good silver mining company. Gatos Silver, part of the Electrum Group, Institute of Scrap Recycling Industries, which represents scrap recyclers in the United States. Kitco Metals and Kitco Media. Coralin Economic Report, Metallic Minerals, mining exploration company and development company, Monex Precious Metals, which is one of the biggest sellers and distributors of silver as well as gold and platinum and palladium in the United States. Cinda Silver, Pan American Silver, Reyna Silver, again, silver mining companies. Sabin Metal Group, which is one of the larger refiners of silver as well as platinum group metals. Silver Corp Metals, big mining company with major properties in China. Southern Silver Exploration, Sunshine Silver Mining and Refining, and the Electrum Group. So these sponsors contribute to and help underwrite the costs of a very large research and operation that we do every year to track precious metals, and in this case, silver, and we appreciate them. We also have media partners, Glacier Publishing. The Northern Miner is not on here. Glacier Publishing and has sold off the Northern Miner, so there are two companies where once there was one. I mentioned Kitco Media already. Metals Daily. Minera Andina is a new media partner here, although it's a company that we've known for 40 years, publishing Spanish language mining information out of Peru. Proactive Investors, which distributes our information and research to institutional investors and individual investors. And Prospector News, Michael Fox's group, which does a tremendous amount of work in distributing information on mining companies as well as precious metals markets and other metal markets. And then we have distributors around the world that are not media partners, and they are not financial sponsors. We're honest about that. But they help distribute our reports by virtue of telling their clients that these reports are available. CGS Events, Gold Blocks, Gold Silver Central, Singapore-based precious metals companies, Intro Act, which again helps distribute our research and consulting services to investors, Prospector News, Southeast Asia Consulting, the David Lynn Report, and Fortel Private in India. So we want to thank all of these companies for all of the assistance they provide us. But I'll talk about the state of the silver market. And here is the silver price daily since January of 2023, not 2014. Sorry about that. And you can see that the silver price, had risen pretty sharply from where it was back in 2014. And over the course of 2023 and the first 2 months of this year, basically was trading sideways between really most of the time between $22 and $26 an ounce. There was a drop down to $20 an ounce in the first quarter of 2023. But then it came back. It was trading around 26, and it's basically been trading sideways. Sideways at a high price. There are people who will tell you that silver prices should be much higher. They probably don't have a firm understanding of the fundamentals of silver mine production, secondary supply, fabrication demand, investment demand, and above ground inventories. The reality is that the silver price is very high. It's high relative to fabrication production costs. It's much more costly to use it in industrial products and manufactured goods and silverware and jewelry than it was prior to the middle of 2019. But it has been moving sideways, and that has disappointed some investors who were told inappropriately that the price should be $50 or $75 or $750 or $3,000 an ounce. And you've seen over the last couple of years a high degree of disenchantment with silver on the part of investors. And Rohit will show you some numbers on sales of ETF positions by some of those disenchanted investors. And it's important to understand that mechanic there, because when you look at the markets and what's been going on, there's similarities between gold and silver markets, but there's one big key difference. The similarities is not just gold and silver, but platinum and palladium and copper and the stock market and treasuries. We have seen globally a shift toward diversifying portfolios, reducing financial risk, and reducing counterparty risk. And that's showing up in U.S. treasuries and the U.S. dollar. The dollar is stronger than a lot of people on the internet would have you believe. And U.S. treasuries are stronger. And the demand for U.S. treasuries, both within the United States and overseas, by central banks that hold part of their reserves in U.S. treasuries, and by private investors ranging from large sovereign wealth funds and pension funds to individual investors and family offices. The demand for U.S. treasuries is at a record level. Overseas holdings of U.S. treasuries rose 10.5% last year to more than $8 trillion. So when you hear people say that central banks or foreigners or investors wherever are dumping U.S. treasuries and then the dollar, you're hearing inaccurate information. The reality is that investors have been flocking to U.S. Treasuries and the dollar and gold. And now, in the last 2 months, silver has joined them again. It sometimes joins them, it sometimes isn't there. But in the last 2 months, we've seen the silver price rise sharply from about $22 an ounce in February to as high as $32 this week. It's a little bit over $30 right now, having come off from that high, but still being relatively high. And what you're seeing is that investors around the world are trying to reduce their risk, trying to diversify their portfolio, and trying to reduce their counterparty risk with financial institutions. And they're doing that because there's this myriad of uncertainties that have grown more significant. If you go back to 2021, 2022, even early 2023, there was a certain degree of consensus in the financial markets. We were headed toward a recession imminently for year after year over that period of time. Didn't happen. And the Fed would have to lower interest rates or stop raising them while they were raising them, and lower rates sooner rather than later because A, no one wanted treasuries. Not true. And B, we were moving toward a recession. It hasn't happened yet. And you've seen investors look at domestic political dysfunctionality in the United States, the UK, in European countries, in Russia, and China, in other countries, and international political problems. They're not geopolitical problems, they're international political problems. As well as financial uncertainty. Are we in fact moving toward a recession? CPM Group's view is that the definition of a soft landing is an extension of the expansion prior to a recession. We've never had an expansion. The only expansion, economic expansion, that hasn't ended in a recession is the current one. And the corollary, which you also need to understand if you're an investor, is that recessions end too. We are in an expansion. It's been stronger than a lot of people thought. That has had inflationary consequences in the United States and in other countries. But we will have a recession at some point. CPM Group would not be surprised to see a recession by the end of this year or into next year. But the timing, the depth, the length of that recession is a question mark. We've been right the last few years in telling our investors and people who plug into these calls that we didn't expect a recession in 2021 or 2022 or 2023, and we haven't seen one. But there are signs of gathering weaknesses in the U.S. economy and in other economies, and we could move into a recession. What would cause that recession would be a combination of factors. Fiscal policy is much more important than monetary policy. Politicians who are responsible for the fiscal imbalances globally love to have people blame monetary policies and monetary authorities for the dysfunction and the large problems that we have financially in the United States and in other countries. But the reality is that the problems start with the fiscal policy that governments make. And monetary policy has kind of become hostage to having to supply the Band-Aids, the monetary Band-Aids, to keep the economies going in the face of the fiscal irresponsibilities of governments. And so it's fiscal policies. And you've seen fiscal spending contractions in the United States and in other countries after many years of being extremely excessive. It's still excessive, but there has been a sharp contraction, and there's probably going to be further contractions. And then developments in the real economy, the real supply and demand of goods and services, all of those factors are showing signs that we're in a mature and maturing expansion, and that we could move into a recession if there are some policy mistakes on the fiscal level and possibly also on the monetary level. A bigger issue are the political problems, which could spill over into economic problems and financial problems. But investors worldwide are trying to reduce their risk, and they're moving to less risky assets. So you've seen people who were buying corporate bonds or municipal bonds and earning 5.8 or higher for 2-year and 10-year notes. They're selling those and they're buying treasuries. Other people have done very well in the stock market. There was a period of time a couple of years ago when everyone was convinced that the stock market would fall 20, 40, 60%. It could on a brief period of time, as it has in the past, but it probably would spring back. And meanwhile, it hasn't happened, and instead you have record stock price levels. Although if you break it down and you don't look at the indices, you look at the individual stocks, a lot of stock prices are suffering. And a few large ones are carrying the indices to record levels. So there's a lot of problems out there, and investors around the world are aware of them, and they're moving into gold and silver and treasuries and dollars to protect themselves from it. People ask us, well, who has been the big buyer in gold, or who is the big buyer in silver? And the answer is everyone. There are people who will tell you that the People's Bank of China was the big buyer in gold. That's not true. Actually, the People's Bank of China in March bought half as much gold as they bought in January and February each, and about 74% less than they were buying on a monthly average basis in 2023. They pulled back from buying gold as the price rose. The price rose because everybody else was buying gold. Private investors tend to chase the gold price higher. Central banks tend to be more price sensitive. They like buying at $2,200, not $2,400. So you have right now, the current situation is, I hate to quote Billy Joel, it's a matter of trust. And in my defense, that's the one song where he was trying to sound like Robert Palmer, so it was okay. I guess perhaps. It's a matter of trust, and trust deteriorating, and increased efforts to protect oneself from gathering storms, economic, financial, and political. That's one of the things that you're seeing. With the price rise over the last week or two in silver, there have been a lot of short-term purchases. And you've heard the people who, I don't know what they call them, if the price of silver breaks over 30, it's going to go to 500 or 1,000, 70, or 50. No, and the price breaks over 30 because of short-term speculative buying. One would expect that short-term in speculative buying is short-term, and when it ends, the price comes back down. And we've seen a $2 decline in the silver price over the last few days, which may reflect a deflation in some of that speculative buying. And it's not just silver. You're seeing that same kind of sharp increase in prices followed by the beginning of a downward move in gold, in platinum, in palladium, in copper. All right, so you have short-term trends, and then you have the longer-term trends. This is the short-term price. This is the long-term price. And here you can see what I was talking about earlier. Those people who say that silver prices are low, don't look at this chart. Silver prices were what, $13, $14, $15, $16 from 2014 until the middle of 2019. So your price of silver, if you're a fabricator, has risen very sharply over the last 5 years. And the price you receive for your silver, if you're a scrap recycler or a mining company, have risen sharply over the last 5 years. And if you're an investor and you like to buy low and sell high, you're looking at very high prices right now. And that's important because of that difference that we're seeing between gold and silver. Gold prices have been rising higher because investors around the world have been buying more gold, including central banks, but they're not the leaders. They're just part of the crowd of people buying gold. In silver, we've seen a period of time aided by those low prices where fabrication demand has been stronger. And fabrication demand has risen very healthy rates over the last 3 years, 2021, 2022, 2023. A lot of people talk about solar, and Rohit will unpack the reality of what's really going on with solar power. But electronics and solar and other uses of silver in fabricated products have risen over the last 3 years, even as investors were growing in their disenchantment that the price of silver was not $50 or $500. That has led to a very tight market in the supply-demand surplus deficit between newly refined silver entering the market from mining and secondary recovery, and the silver being used in fabricated products. There's much less physical silver in above ground inventories that are readily available for sale. And when investors over the last 2 months said, we want to buy more silver, they had to bid the price up. Mine production takes a long time to increase. Secondary recovery takes at least 2 weeks, and in a tight market could take 2 months or longer to see. Fabricators can cut back on their purchases relatively quickly, but the place where you extract more silver, if you have new investors coming in and buying on a short-term sudden basis, are other investors, some of whom are bought at $12 and $14, and they're saying, okay, at $30, it's yours. Or they bought at $30 in 2021 because they heard it was going to 75 or 750, or triple-digit silver, as one of the more inaccurate promoters kept saying. And they said, okay, I've been sitting on this stuff at $30, $31, $32, $33 an ounce, and it went back down to 18. Now it's back up to 30. Take it. So the easiest place for new investors buying additional amounts of silver over the last 6 weeks and going forward, the easiest place for them to find that silver are people who hold silver in above ground inventories. That's very important to understand, because some of those people are willing sellers at $30, and some of them are not. I've gone on probably longer than I wanted to, but I want to put this one up. These are CPM Group's real and nominal silver price projections from our 10-year silver price report that we issued in December 2021. And in December 2021, the price of silver was around $20, $21 an ounce, if I recall. And we get you, these are annual average prices. You could see, the red is the nominal price of silver. We had the nominal price of silver being flat in 2021, 2022, 2023, rising sharply in 2024 and 2025, with nominal prices averaging more than $40 and not real inflation-adjusted prices averaging close to $40, right? So real prices reaching a record level. Now, in the ensuing years, we've reduced that target on the annual average price. But I point this out because, we were right. And there are a number of people who say, well, CPM Group is bearish on silver, and CPM Group is only now turning bullish on silver. And those people really don't know what they're talking about. But then that's true of most parts of human life, right? There are any number of people who like to talk about stuff they don't know anything about. The reality is that CPM Group has been projecting a period of sharply higher prices in 2024, 2025 for several years. My colleagues were a little bit concerned about putting this out, and we did black out projections from 2027 through 2030. And, we do this on an ongoing basis quarterly. So we now have prices projected out to 2033. And they thought, well, some people will look at this chart and say, why would I need to buy any CPM group research or consulting? Because here they're giving us their long-term projections. And, my view was that anybody who thinks they should be investing on what we thought 4 years ago or 3 years ago, probably we would never be our client anyway. Obviously, our views have changed when the realities of the markets have changed. And we have views as to where the market's going now. But the reality is that we have been saying that we thought we'd get into this kind of situation in silver in 2024, 2025, and that's where it is. It's maybe come a little bit sooner than we had thought, in that the concerns that are leading to that movement to less risky portfolios and reducing counterparty risk has been much stronger March, April, May than we thought it would be at this time of year. We thought most of it would happen in the second half of this year. We still think that most of it will happen in the second half of this year. So if the silver price and the gold prices have reached levels in the second quarter that we thought they would reach in the fourth quarter, it's not that we think that prices are peaking. It's that the demand for these metals by concerned investors worldwide is greater than we had expected sooner. And we think that the economic and political conditions that are leading investors to buy increased amounts of gold and silver will continue to deteriorate, so that we'll probably see even higher prices in the second half of this year than before. One last chart. CPM Group reports above ground silver bullion inventories. They are at record levels, and most of it is owned by investors. The green part here are coins, more than 1 billion ounces of silver bullion coins held by investors. The yellow part are implied or unreported silver bullion inventories. About half of that may be owned by industrial companies, or rather financial institutions that lease that metal to producers, refiners, smelters, and fabricators, and wholesalers and retailers. When you go into a department store or a jewelry store, depending on the jewelry store, if it's a large chain and you see gold and silver jewelry, a lot of times the gold and silver in that jewelry at that retail outlet is actually leased to the retailer by a bullion bank or a trading company. And that frees up capital for the retailers so that they don't have all of their money tied up in inventories. And it also gives them price protection, because they're not buying the gold and silver in that jewelry until they're selling that gold and that jewelry. So they have a perfect hedge, if you will, or a natural hedge, in that they're not actually buying that metal until they're selling it. They don't have to worry about buying the silver at $31 in 2021 and selling it in jewelry form when the price is $18 or $20 or $22. So some of that unreported inventories, perhaps half of it, is in working inventories in the industry, and most of it is owned by financial intermediaries. And there are people who rail against the presence of banks and trading companies in the physical gold and silver markets. But if they weren't there buying from producers and leasing it to fabricators, the market would be much less liquid, there'd be much less demand, and the prices probably would be lower. They provide a very important financial service in the markets that is gruesomely misunderstood or totally not even known to exist by a lot of people who like to hold themselves out as gold and silver investors or experts. there's a lot of above ground silver inventories. Other people use the term available inventories, and I used it earlier to talk about the silver bullion that is available to new investors, saying the silver that's available to investors who want to buy now, the most readily available silver is silver that is held in refined form in coins and bullion bars by other investors. Investors who bought low and they want to sell at what they see as a higher price. Investors who bought high and they want to recoup some of their losses because that they've been sitting on for 4 years. And other investors who say, well, this is good. This is a good return. I think I'll take my money and go into something else. So that's where the market's been lying. I'm going to turn the screen and the microphone over to Rohit now. Bear with me while I try to do that. And that's going to involve me doing this and saying yes. He'll talk about investment demand, total supply, and fabrication demand. And then we'll come back for questions and answers.
Thank you, Jeff. So let's start here with investment demand.
Okay.
Sorry, I'm Apple. So last year we saw net silver investment demand stand at about 12.5 million ounces, which was down pretty sharply from 56.6 million ounces in 2022. You had a couple of periods last year when investors were large buyers of silver, but then you had many more months when they were smaller sellers, which ended up resulting in these net additions getting compressed last year. One of the periods last year when you saw a uptick in silver investment demand was around the March-May period, when you had the failure of, or rather the collapse of Credit Suisse and the failure of 3 US regional banks. And there was elevated concern about whether these failures would spread to other portions of the banking system, whether it raised concerns about a recession, which was already a concern for market participants even before these failures had happened. However, these bank failures remain pretty contained, and the economies around the world, especially the US, continue to grow. You had the Fed going on to raise rates through the middle of last year, even though the markets were expecting them to cut rates. And you had inflation softening over the course of the year as well. So you had all these factors coming together, which kind of dampened silver investment demand and prices beyond that March through May period. And investment demand as well as prices remained relatively soft till we reached the end of the year, when because of softening inflation, there was renewed optimism about the Fed cutting rates. And you saw investors across markets pushing up asset prices, and that basically resulted in an increase again in silver investment demand. So you did have a couple of periods last year when you saw strong silver investment demand, but for the most part, investors were selling small amounts of silver last year. So that also helps to explain why silver prices were somewhat sideways over the course of the year. This year, we project that net silver investment demand would be around 11 million ounces. We still see investors as net buyers of the metal. A lot of political, economic factors that are driving investors towards silver. You also have strong demand and expectations of strong demand from the solar panel industry, which is also supporting this investment demand. However, there are a lot of investors, past buyers of the metal, who bought silver in expectation of new record highs. And those highs have just not materialized. And it's been years, it's been nearly 13 years now that silver prices reached record high levels. So there's a bit of disappointment among some investors with regards to how silver has been performing. Then when they look at gold and see that gold has been, reaching new record levels, that adds to that disappointment. So we do see that some of these investors are likely to sell into the rally. And that, again, is something we think that will weigh on net silver investment demand during the current year. That said, as Jeff showed in a previous chart, our price expectation is for silver prices to rise. We do think that silver prices will reach new record levels. But for that to happen, we do need some of this so-called stale bull liquidation to be finished and behind us, so as to clear the way for higher investment demand, as well as higher net investment demand, as well as higher prices. So what we're looking at here is silver ETF holdings. And last year, again, silver ETF investors were net sellers. This was the second consecutive year they were net sellers. They sold around 40 million ounces last year, which is much smaller than the record 120 million ounces that was sold in the previous year. But that combined net sales over the last 2 years is still just a third of what was added to these products between 2019 and 2021. So you still have the amount of silver held in these products at higher levels than what they were prior to COVID. This year so far, or rather through the end of April, they've been small net buyers. And again, this trend could continue, but we don't anticipate very large net purchases this year. But maybe going forward, you might start seeing an uptick again in net purchases in silver ETFs. The silver coin demand as well came off during 2023. You had it at 111 million ounces. So this was down from 122 million ounces in 2022. While this was the third year that silver coin demand declined, when you look at the amount of demand last year, that's still high by historic standards. So one of the factors that was negatively affecting coin demand was the high premiums that coin investors were paying, and also the relatively high silver prices. So on average, last year, you had silver prices higher than what they were in 2022. But that said, these investors are longer-term investors. So while they are sensitive to prices, they are also looking at these products from a more longer-term point of view and as a portfolio hedge for a lot of the political and economic risks that they've been worried about for some time now. So that has helped to keep coin demand at elevated levels, despite the fact that they have come off over the last 3 years. Also, with regards to price, while prices were higher in 2023 on average by around 8% compared to 2022, they were lower than what they were in 2021. And also, a lot of these investors are looking at the tremendous upside potential that silver prices have, given the positive fundamentals, and also how a lot of them may look at how silver has been performing compared to gold, which shares a lot of the same factors that influence investment demand. So a lot of the political and economic factors that influence investment demand for gold are also supportive of silver, and you haven't really seen that being reflected in silver prices. So there is still that anticipation and hope that silver prices will rise in the longer term, which we do think they will. So this chart shows you the gold to silver ratio, and you can see that silver has massively underperformed gold. This is monthly data as of April. So this has changed in favor of silver over the last couple of weeks, but it's still underperforming gold. And while we don't suggest that anyone should be buying or selling gold or silver based on this ratio, just the sheer underperformance of silver, along with the fact that there are supportive fundamentals for silver prices to rise, um, this suggests that there is a fair probability on a relative value basis that silver prices could rise in the near term. So with that, we move on to fabrication demand. So fabrication demand has been rising. It rose for the third consecutive year in 2023. It reached a record high 970 million ounces, which was up around 3% from 2022 levels. Last year's growth in fabrication demand was almost entirely driven by strength in demand from the solar panel industry. You had declines, meanwhile, in other major sectors like jewelry, electronics, as well as photography. This year, we expect silver fabrication demand to continue rising, reaching new record levels. We forecast that global silver fabrication demand this year would be 985 million ounces, which would be about 1.5% higher than what it was last year. And we do think that this year, the growth in silver fabrication demand will be more broad-based, and that a lot more sectors would be engaged in contributing to that growth during 2024. So we don't expect just solar panels to contribute to that growth, but we also think jewelry as well as electronics will help to push total silver fabrication demand higher. The only exception is photography, which has been in a long-term declining trend as a result of the growth in digital imaging. So this chart shows you the amount of silver consumed by the solar panel industry. And as you can see, there was a large jump in demand last year. It reached new record highs. It was 193 million ounces in 2023. And this increase was a combination of an increase in panel installations as well as production, as well as a growing market share of more silver-intensive solar panels. So you are seeing new, more efficient solar panels being introduced into the market, which do contain a higher amount of silver compared to the PERC technology, which has been dominant over the past few years. We expect that silver demand from this sector will continue to rise this year. We're forecasting that level of demand to be around 203 million ounces, which is a little more than twice what it was back in 2021. So in 2021, it was close to around 100 million ounces, and it's more than doubled since then. A lot of the trends that we saw last year would continue. We think that the growth and market share for these new technologies, which use higher silver content, would be the main driving force behind the increase in silver demand from this source. That said, there are some factors that could act as headwinds to silver demand from this sector. So one is, while we do think installations of solar panels will rise during 2024, at least some portion of that demand is expected to be met by the excess supply that we've seen come on stream of these panels over the last few years. So that would dampen the growth rate of silver demand from this source during 2024. You're also seeing bottlenecks forming especially in China, where there is such a large amount of solar power being produced. So there are bottlenecks forming in certain regions where there is more power than what the grids can take in. And so you are seeing the grids trying to disincentivize some of the solar panel, or rather solar energy. So that is something that, again, would act as a headwind. That said, the positives with regards to silver demand from the solar panel industry are expected to outweigh any of these negative factors that would be on demand. But they will, or are expected to, slow the growth growth rate of silver demand from this sector. So silver jewelry demand declined pretty sharply last year. It slipped to 296 million ounces, which was an 11% decline from 2022 levels. And a major part of that weakness that we saw in 2023 was tied to a normalization of demand in India. But even excluding India and the correction that you saw in the demand during 2023 compared to 2022, weak demand from China, a decline in demand from Europe, and a slight uptick in prices, but are all other factors that also weighed on jewelry demand. So even when you exclude Indian demand completely from this, you still see a reduction in the amount of silver that went into the jewelry sector. So with regards to India, what happened was in 2020 and 2021, you had a bunch of supply-demand disruptions because of COVID. In 2022, with a lot of these restrictions being removed, you saw a jump in restocking by jewelers. And they were also trying to take advantage of the relatively lower price in 2022 compared to the prior years. In 2023, you saw that restocking being completed. And you also had slightly higher prices, so that was another headwind. Still, when you look at silver demand during 2023, it was higher than what it was back in silver demand from India in the jewelry sector in 2023 was higher than what it was in 2019. And that's really a reflection of strong economic growth in India. And that's what was helping silver jewelry demand last year. This year, we expect it to remain flat on levels that it was in 2023. You have the higher price, which is going to act as a negative to demand. But you do have a healthy economy still, and that's something that would be supportive of silver jewelry demand in the country. Then you had China, which had a relatively weak recovery in 2023 post-COVID. So that was something that weighed on Chinese demand. And a lot of the Chinese consumers were focused last year on gold. So when we covered our Gold Yearbook, we did see that there was a increase in demand from Chinese consumers for gold, but not so much for silver. So these were factors that hurt Chinese demand last year. We don't think that either of those factors would have as much of a negative influence this year. And we think that Chinese demand would improve, and we expect that is really what is contributing to the increase that we're seeing in jewelry demand during 2024. So in 2024, we expect global silver jewelry demand to stand at 297.6 million ounces. And while this is an increase, it is still lower in total compared to what it was prior to COVID. So we still haven't made a recovery back to levels that it was at prior to COVID. So electronics demand declined to 223.5 million ounces last year. There were both sector-specific as well as macro factors that were hurting electronics demand. On a macro level, you had concerns of a global recession in the first half of last year, which was dampening both consumer as well as business sentiment. You also have that weak recovery in Chinese economic growth last year. So these were factors that were hurting silver demand from the electronic sector in the first half of last year. You also had industry-specific issues in that you had the electronics industry working down the massive amount of inventory that was built up in the electronics during 2022 following the chip shortage post-COVID. In the second half of last year, you did see an uptick in electronics demand because the recession that was expected did not happen. There was an uptick in both consumer as well as business sentiment. But that increase was not sufficient to offset some of those negatives that we saw in the first half of last year. This year, we think that electronics demand, silver demand from the electronics sector would rise. We are anticipating that level to be around 227.4 million ounces, which would be an increase of roughly 2%. You have a lot of the headwinds that you had last year, they don't exist this year. And you also have increased demand from the AI sector, which is something that is expected to help support silver demand. Just one thing, last year, while you had consumer electronics and business investment in electronics being relatively soft, one sector within the electronics that was doing well was the auto sector. So the auto sector actually helped to provide a good amount of support to silver demand from electronics last year. You have an increased amount of electronics being introduced into all cars. EVs use more silver than internal combustion engine vehicles. And then you also had a growth in market share of these EVs last year. So collectively, all of those factors helped to increase silver demand from the auto sector during 2023. So on the supply side, which is made up primarily of mine supply and scrap supply, you saw a decline of 1.6% in 2023. Total supply last year stood at 983 million ounces, which was driven entirely by a decline in mine supply, which slipped by around 20 million ounces last year. You had scrap supply, which rose by around 4.5 million ounces, but that was not sufficient to offset that weakness in mine supply. Mine supply has really been in a declining trend since 2016, when it hit a record high of 827 million ounces. And there's been a bunch of factors that have contributed to that decline in mine supply. So one is the lack of investment in the sector, which is not specific only to silver. It's something that we see across metals industry. And while you are seeing some uptick in investments in the mining sector over the past couple of years, for that to actually show up in mine supply would take several years from now. And then additionally, you had the closure and suspensions of some major silver mines over the past few years, due to political reasons or economic reasons, which has also contributed to weighing on total silver mine supply. So in 2023, we saw silver mine supply standing at 747 million ounces, which was 10% lower than where it was in 2016. And in 2024, we forecast that mine supply will increase to around 756 million ounces, but would still be lower than where it was back in 2022. So overall, the amount of metal coming out of mine supply is essentially flat to declining. Scrap supply, meanwhile, you've seen scrap supply increase last year to around 235 million ounces, which was the highest level of scrap supply for silver since 2012. You had increased recovery of silver from industrial sources, and you also had an uptick in Indian jewelry scrap because of the higher domestic price. This year, scrap supply is expected to join in with mine supply, and both sources of supply are expected to rise, taking total supply to 996.7 million ounces. So this chart shows us new mine capacity, and last year you essentially had no new silver mines that were producing more than 500,000 ounces of silver. So this chart only includes mines that would produce more than 500,000 ounces of silver. This has been a trend. It's clearly been a trend in place now since 2013, where you're seeing a ongoing decline. And this year we do think, this year it's expected that there would be a new capacity addition of around 10 million ounces. But if you average that out between 2023 and 2024, it gives you 5 million ounces, which would still be lower for 2023 compared to what it was in 2022. So essentially, that trend of declining new supply coming on stream is still very much in place in the silver mining industry. And what you're looking at here is the cash cost curve, and cost rose for the third consecutive year during 2023, reached a record high on a production-weighted basis of $11.4 an ounce. It was a combination of relatively high inflation, general inflation, as well as relatively strong silver prices. So we have seen that the general inflation that we had in the global economy and the problems that created, especially on the labor side in the mining industry. But you also have the stronger silver price, which typically tends to result in mining companies mining low-grade ores, as well as the increase in demand for various inputs into mining. So all of those factors collectively have contributed to that increase that we've been seeing in costs over the past few years. We think that this year as well, we are likely to see an increase in cost, primarily driven by stronger silver prices. So with that, I will pass this back to Jeff, and we can open it up for questions.
You want to pass the screen back to me too, or?
Yeah.
Thank you, Rohit. Thank you all for staying around. We'll open it up for questions now. I'll pull this chart back up. This is the bottom line. And as Rohit was explaining, and as I mentioned earlier, you have seen a growing tightness in the surplus of metal being newly refined from scrap and mine production relative to fabrication requirements in solar panels and a number of other uses. And with investors now showing renewed interest in buying silver, they have to find people willing to sell it to them. And right now, and possibly going forward, what you'll see is the most readily available metal is that metal which is available from investors who want to take profits. So how that factors into net investment demand, we'll have to wait and see. But I guess when you put it all together, that's where it is. Before we get into the questions, yes, you may buy this book. It's an ebook. It's $160. It is not available now, but by the end of today, it will be available on our website, at our store. Here's the link, and you may purchase the book, download it as an ebook. There are instructions on the last page. If you want to get a printed copy, there are the print instructions. You can take it to a print shop, and they'll print it, and if they have the capacity, they can also make it a perfect bound book. I think the costs are probably about $25 or so. This is the book from last year, and I had a copy bound, printed and bound, just to make sure that it works. We'll open it up for questions, and Carlos can help with some of the questions. I'll take the first one just to get the ball rolling, which are there signs that investors prefer gold more than silver these days? And yes, and I think that goes back to this balance sheet and some of the things that Roa and I have been discussing. I think more investors in more parts of the world see gold as a quasi-monetary and a financial asset and a portfolio diversifier and a store of wealth and an inflation hedge, a currency hedge, a hedge against uncertainties, whether they're political, economic, or financial. And you're seeing that in the fact that the gold price has been being pushed higher by rising net investment demand by producers or by investors while the silver price is being pushed higher in a tightly balanced market, where it appears that over the last 6 weeks at least, the increased investor demand from various investors has been met primarily by other investors taking profits. Carlos, do you want to take over and run these questions, or shall I?
Sure, I can ask several of the questions. We actually received about 80 plus questions prior to today's presentation. So I'll start with some of those that we didn't really, or maybe we did cover a decent amount in the presentation. So one of them is, can you talk about the cost to produce silver?
Rohit, you want to take it?
Sure. So the average cost was about $11.40 last year when you do it on a production weighted basis.
That's the cash cost from several dozen primary silver mines. There, 70% or so comes from byproduct, from gold, copper, lead, and zinc mines, and their companies account for it in different ways. Some companies will attribute part of their overall production costs to their byproduct silver. Others will say, no, my gold, copper, lead, and zinc covers my costs, and the silver revenue is really, and profitability is really just after I have extracted the primary metals and other metals, and I have tank house slimes at a refinery that has silver. The refinery may charge me $1 or $2 an ounce to refine the silver from there. Therefore, my cash costs for producing silver are $1 or $2. So the cash costs are kind of skewed by the reality that you have such a large portion coming from byproduct mines. Then there's the all-in sustaining costs, and I'm not sure that the silver industry actually publishes those, but they are, from what we can tell, in the middle to high teens on average. There are some companies that have very low all-in sustaining costs, and there are some companies that have much higher all-in sustaining costs. Next.
Okay, and the next one of the interesting questions is, if recessionary conditions do appear over the next several quarters, how would we expect silver prices to react?
That's a tough question to answer. I mean, if we look at past recessions, what we've seen really since the 1980s, silver prices peaked in the period. Silver prices peaked in the period just before the 1980 recession. And they fell sharply before that. And then they moved pretty much sideways, but at much higher prices than they had been at prior to the recession. It was a double dip recession in 1980 and then another one in 1981-82. The next recession that we saw wasn't until 1991. The silver price had fallen to around $3.50, and it basically moved sideways. You didn't really necessarily see investors buying a lot of silver at that point. The silver price didn't really start rising until 1993. The next recession that we saw was 2001, and the silver price really didn't respond too much. I mean, if you think about it, silver investment demand doesn't necessarily increase during a recession unless there's a lot of fears that the recession will be much larger and atypically larger and more severe than it would be. And then fabrication demand can be hurt during a recession. Going forward beyond 2001, the next recession was the Great Recession, 2007 through 2009. And the silver price rose very strongly through that period of time. But the silver price had already started rising in 2005, again, in the late stages of the economic expansion, similar to where we are today. you saw the silver price break above $5, $5.50. It had been trading between 3.5 and 5.5 for about 15, 16 years. It broke above $5.50 in 2005 or so as investors started buying more silver. And it rose during the late stages of the expansion through the recession and then into the recovery. But the recovery period was characterized by sovereign debt concerns, primarily in Europe with the southern tier of the Eurozone. So Ireland, Portugal, Spain, Italy, and Greece, especially Greece, were problematic. But you also had concerns over fiscal irresponsibility in the United States and a stalemated government, which led to the U.S. Treasury in credit rating being downgraded for the first time in history in August of 2011. The silver price rose into April of 2011, and then it started to decline the first week of May, and it was already deflating by the time that happened. So the correlation between recessions and expansions and silver price increases is not a particularly strong one. I think that's it.
Okay. Another interesting question is, could silver go into a deficit given the strong demand and strong growth rate for silver use in solar demand?
Well, I'll answer and then I'll see if Rohit wants to join in on the solar. Yes, it can. The big trigger, you can see, and we've gone very close. We've gone within 11, 12 million ounces of a deficit over the last couple of years. And actually, if I go back here, you can see that we also got very low in the period 2017, 2018, 2019. You can see the market move into a deficit due to rising fabrication demand and perhaps lower supply. But typically, if you go back here to the 1970s, and then this was a recession there, this was a recession 1969, 1970, but it was coming after 80 years of silver prices being basically settled or heavily influenced, we should say, by the U.S. Treasury holding billions of ounces of silver under various silver purchase acts. So that's a not particularly a good example. Here you saw the movement into a deficit as a direct result primarily of investors selling silver rather than fabrication demand rising. So you saw investor disenchantment. There was a lot of investment demand in 1980, 81, 82, 83. We had recessions. We saw the hunt. We're buying silver prices, not because of the hunts, because everything was rising in 1979. The hunts contributed very little to the actual price increase, but you saw the price of silver spike to $50, which brought a lot of investors in for several years. And then as the 80s progressed, they grew progressively disenchanted because the price went to $16 in 1980, and then $8, and then $7, and then $5, and then $3.50. And investors were selling into that, even as other investors were buying. But by 1990, you had net investors selling, which lasted for 15 years. That kept the price down in that $3.50 to $5.50 range. And that then stimulated further fabrication demand. Now, we're in a radically different situation today because the fabrication demand is rising due to the advent and introduction of solar power and the increased use of electronics across virtually every product that you have. Robert was talking about automobiles, but let's be honest, the use of electronics has increased in everything that you have, just about. From televisions and refrigerators to toys. So you're in a relatively different situation, and you could see a deficit emerge due to rising fabrication demand. But that would take continued disenchantment on the part of investors. For fabricators to say, we need to bid the silver away from investors. We need to be willing to pay enough for silver to cause investors to say, okay, if you think the prices should be $30, $32, $35, whatever, we will sell you silver. That could happen, but it's going to be a combination. It would have to be a combination of very strong fabrication demand from price inelastic uses like solar and investor disenchantment continuing and worsening. Rohit, do you want to add anything to that?
I think that covers all of the topics. I think a combination of supply not being able to rise in the next few years, and all of this increase in fabrication demand, there is a risk of possible deficit there.
Okay, the next question is, do we see a new energy demand for silver apart from solar demand?
There's some use, because what we're really doing is we're moving toward electrification, moving as much as possible. And silver is a vital raw material for a lot of electrical applications. And in other applications, silver is the low-cost substitute for palladium or platinum or gold. So you'll see, and we've already seen over the last 30 years, for example, places where semiconductors and other electronic goods used palladium, they switched to palladium-plated silver. So they could use more silver and less palladium because the price differential was such. So we do see, insofar as the energy transition, if that's what you want to call it, is really a move toward increasing electrification wherever possible, that should benefit silver demand. I will say that, the International Energy Agency just released last week its energy outlook report for 2024, and it's available online for free, and you can get it. It's very interesting. And in it, they look at solar use of, they don't look at solar use of silver. They look at solar power and the production of solar panels versus the use and purchase and installation of solar panels. And they have a plateauing of the amount of panels being manufactured, but much more importantly, they have a capacity utilization in the solar panel industry of around 40%. And that's a very low level of capacity utilization. And it's already actually emerged in the last couple of years. And that's kind of a warning sign. And it's contraindicative from those people who say that, silver use in solar panels is going to be 500 or 800 million ounces, because what it suggests is that the solar panel manufacturing capacity has risen far faster and further than the demand for solar panels. And they have that persisting for the next 10 years. So that's kind of a cautionary tale. Don't get too enthusiastic about silver use in solar panels, because yes, it's going to grow, but there are complicated economics on the supply of solar panels and the use of silver in solar panels and the deployment of those solar panels. Rohit, you have anything to add to that?
No.
Okay.
Okay, another question. What are your thoughts and insights on silver hedging activity by producers?
Most of the silver hedging that we've seen has been from byproduct producers who, for whom the silver is not the main metal. And just as background for our viewers, Carlos is in charge of our commodity management services. We provide hedging advisory services, pricing, structuring, and even management of hedging positions for producers, intermediaries, fabricators, and investors. So, we're kind of familiar with this, and some of the byproduct producers do hedge. We have seen hedging shift from forwards to options to compound options, as some of these producers have gained sophistication in their financial understanding of how futures, forwards, and options work. We haven't seen a lot of increase in hedging. We wouldn't be surprised to see increased hedging, but I have to also add here, hedging, whether you use forwards or futures or options, does not involve physical metal in any way, shape, or form. When a producer hedges, there's no spot sale of physical metal into the market. And when that hedge is closed out or delivered into, if it's closed out, there's no spot increase in silver or in the market. There are misunderstandings that have persisted for a long period of time since the 90s that producer hedging somehow or other involves spot metal sales. And that's not true. And we worked with the World Gold Council. We had position papers in the early 90s that our producer clients used to understand the mechanics of hedging. There was a World Gold Council actually put together a meeting, I guess maybe about 15 years ago, with its members, and they brought in a couple people from major bullion banks to talk about hedging. It was done under the Chatham House rules. So no, we can say what was said, but we can't say who said it. But basically, the representatives of the bullion banks explained that they don't use physical metal in their hedging, including delta hedging. Delta hedging does not involve physical metals either. It's something to pay attention to. Hedging is very important because it improves the financial performance of mining companies by protecting them from the downside, and if done properly, retaining upside exposure to rising prices. That's the way we like to do it. Hedging is good for the financial performance of the hedging company if it's done properly. It does not affect the physical supply and demand of metals, if that's what you're worried about.
Okay, and this is the last question, and it's actually a combination of many questions that we've received, and it's all about prices on our outlook from the next month, the next 2 months, to the next year, to the next 5 years, the ranges. So what is our outlook for silver prices for all these ranges that I've mentioned?
Rohit, you want to do that, or should I?
I mean, over the next few months, we have prices coming off, and then have them rising as the year comes to an end. And on an average basis, we have them going up over the next couple of years, possibly reaching record high levels. So,
yeah, the purpose of our Silver Yearbooks has always been to provide the basic supply-demand statistics and an accurate, unbiased analysis of the silver market, supply, demand, investment demand, above-ground inventories, and provide that to a range of silver market participants to allow them to formulate their own view of silver prices. We do have our own views. They range from 2 weeks to 10 years for gold and silver. We're taking our platinum projections out to 2050 right now. We do the same things for high purity manganese, molybdenum, tantalum, niobium, the 6 base metals that we have that are traded on the LME. We have 5 and 10-year projections for, but those are for our paying clients. To be honest with you, we'll gladly take anybody as well, not anybody, but we gladly take people as paying clients if they want to have a CPM Group's explicit projections, short and long term, and explanation as to the fundamentals and the macroeconomic and international and domestic political issues behind those projections. There were a couple other questions that I would throw out. One was someone asked us about our view of silver equities. And CPM Group is a CFTC registered commodities trading advisor that focuses on commodity markets. We are not an SEC registered equity analyst. And for a variety of reasons, we've never wanted to be, and I'm not sure that why we would want to be today. So we don't publish or publicly discuss our view of mining equities individually. We do a lot of research looking at the relationship between metals prices and equity prices. And there's a lot of discussion now in the market that we should focus on a little bit right now. Metals prices, not just precious metals, not just silver, but copper, base metals, steel, have risen sharply, but the equities of mining companies, by and large, have lagged sharply and not risen. There is wishful thinking on the part of a lot of mining company managements and investors in these mining companies that look at this break between metals prices and mining equity prices and say, okay, well, at some point, the mining equities will catch up with the metals price increases. We're not convinced that that's going to happen. Our analysis, and we've been doing this for a long time, our analysis since at least 2017, 2018, has been that there are major changes in the equity markets and the investment markets and the investment attitude toward investing in equities, not just mining equities, but equities in general. You've seen a tremendous shift in equity investment away from managed investment decisions to indexed funds, indexed ETFs, and quantitatively driven investment decisions. And those have caused a break between stock market performance and capital formation, not just in mining, but across companies. And we think that for the foreseeable future, that divorce between metals prices and mining equity prices will persist because of factors beyond the mining sector and beyond the metals markets having to do with fundamental secular long-term changes in the equity investment market, which leads to something that I scribbled down for myself a few weeks ago. You should plan for a future that seems most likely, not for a future that you hope will emerge. And we're concerned that the mining equity market will suffer from this secular change for the worse in the equity market. And we are spending analytic firepower thinking about what needs to happen in the mining equity space to improve the access to capital needed to develop these mines. Because the mining industry, like many other industries, is suffering from equity investor distraction. They've moved on to other mechanisms that preclude some of the fundamental capital requirements of the mining industry. So we're spending a lot of intellectual firepower thinking about what can be done to bring the capital needed to the mining industry. That ties in with another question that we didn't address, which was, do we think that there could be a sharp decline in, well, the question was, is there, the question related to decline in silver production at mines. And there could be. It's not for lack of reserves and resources. There are enormous reserves and resources of silver around the world to be mined. Some of them are privately held, or they're held by entities that don't get involved in the public markets in North America or Europe. And they are astoundingly large. So there is plenty of silver to be mined. Whether it gets mined has to do with whether the mining industry collectively can figure out how to attract the capital needed to develop some of these very attractive deposits going forward. So that's a little bit to the side of the purpose of the Silver Yearbook and this briefing, but I think it is important to talk about. Again, you can buy this book. It will be available. You can pre-order it today, and it will be posted for delivery later today. And it's $160, and it's 293 pages this year. It's the definitive work of accurate statistics of the supply and demand and availability of physical silver, as it has been since the early 1970s when it was first produced by Jay Aaron's research department. You may go to our website, cpmgroup.com, buy the book, buy a gold yearbook that came out in March, pre-order the platinum yearbook that comes out in July. You can look at other reports that we produce, including those long-term reports that I showed you the chart from at the beginning. You can send us an email at info@cpmgroup.com and say, I would like to talk to CPM Group about ways that CPM Group can help me manage my exposure to commodities, silver or other commodities, in a better way. Informed, research-driven, unbiased. We're not marketing. No one pays us to tell investors to buy gold, silver, or platinum group metals or other things. They pay us to give them an accurate, sober, unbiased view of the markets, what's really happening in supply and demand, knock down a lot of the misinformation that you see in the markets, focus on what's likely to happen, not what we would hope to happen. On that note, I guess we're done. Thank you. Have a good day. And we'll talk to you in July when it comes time for platinum, unless we talk to you sooner about something else unilaterally. Take care.